Hello students, welcome to Prudential Business. So students, in our previous classes we were continuing with the chapter financial management, right? So in our previous video classes we have discussed about the concept of financial management. We have also discussed about the role played by financial management in every company. We have also discussed about the objectives of financial management, right? So just a recap of what we have already discussed in the video class of the objectives of financial management is that the primary objective of every financial management is to increase the wealth of the equity shareholders, right? So whenever we say that the wealth of the equity shareholders are increasing, that we need to think that the company's residual amount of profits are increasing, because equity shareholders are only entitled to the residual amount of profits. So that residual amount of profits is the leftover amount of profits, right? Leftover amount of profits after the company has paid to all those secured creditors and also the preferential creditors. Whatever left out amount of money is there, that amount of money is entitled to the equity shareholders. So the basic objective of every financial management is to increase the wealth of the equity shareholders. That means to enhance the company's residual profits, right? I hope this is clear to you. So all those videos will be there in this YouTube channel under the playlist financial management. Okay, so in this video class we will be proceeding further. Here in this video class we will be discussing about the three major decisions that are usually taken under financial management. At the beginning of our class I have said that whenever you see the word financial management, you need to think about the three important decisions that are taken under it. That can be your financing decision, right? So whenever we say it as a financing decision, it refers to the sources of our financer. That means who is going to finance us, who is going to give us money to do business, right? It can be your bank or it can be your general public. Choosing a bank, that means taking a debt capital, or choosing the public for as a sources of financer, that means you need to rely upon equity financing, right? So we will be discussing that in details in our coming slides. So that will be the first decision that is taken under financial management. Now the second important decision is about your investment decision. So in the first case we have decided who will finance us, and in the second case we will need to decide that after we got the amount of money, where are we going to deploy the amount of money, right? How are we going to utilize that amount of money? So that will be discussed under your investment decision, right? So investment decision basically decides how successfully or how meaningfully are we going to allocate the funds into our business, right? That is the second decision. And the third decision is about dividend decision. So under dividend decision, every company decides how they are going to distribute the amount of profits. So in investment decision, that is a second stage. In investment decision, we have done our business by taking the money. In the third case, we are going to distribute the profits of our business to all our stakeholders, to all the persons who have financed us, right? So those decisions are taken under dividend decision. That means dispersal of funds or distribution of funds to all our stakeholders, to all our financiers, right? So those things will be discussed in details. Now for this particular video, it will not be possible to discuss all those three decisions together. So we will be bifurcating the video into three different videos, and for the first video we will be concentrating our discussion only in the cases with financing decision. Okay, so the first decision is about financing decision. Here you see financing decision refers to the financing pattern or the proposition of debt and equity. Here you see under financing decision you need to decide who is going to finance you. Okay, that financer may not necessarily be your bank and not necessarily be your general public. If you choose bank, then it will be your debt financing. If you choose the general public, it will be your equity financing, right? It can be a mixture of both of the two. It can be a mixture of debt and it can be also a proportion of equity. But that debt and debt equity, how much amount of money you are going to collect as from debt and how much amount of money you are going to collect as equity, that will differ. That differs significantly in terms of cost and risks. See in the second paragraph. debt and equity differ significantly in terms of cost and risk. Now you see, what is that cost and risk? In the cases with your debt financing, that is taking a loan from a bank or financial institution, after you have taken the loan, you need to repay that amount of loan by paying a regular amount of interest, even if your company does not make profit. So that makes debt financing very riskier, right? I hope this is clear to you. But take for that instance in the cases with equity. As per law, in class 11 you have learned, as per the legal obligation, a company is not under pressure, or it is not necessary for a company to repay back to the equity shareholders if the company does not make adequate profit. They need to repay back to the equity shareholders only if they have got sufficient amount of funds for repayment. If they does not have any amount of money for repayment, they are under no legal obligation to repay back to the equity shareholders. I hope it is clear. So that is the difference between the cost in terms of debt and in case of equity. Now come to the concept of risk. See how it differs, this cost and risk, how it differs in the terms of debt and in the terms of equity. Here you see, we have discussed about the concept of debt and equity in how it differs in the terms of risk. Now let us say about the cost. Whenever you take a loan from a particular bank or any other financial institution, you need to see the cost. Usually cost is much lesser whenever you take a loan from a bank, but that cost is much more whenever you choose equity financing. That means by raising the amount of money from the general public, right? Now you see the amount of cost. Whenever we say cost, it usually refers to the flotation cost. Flotation cost, examples of flotation cost can be your brokerage, can be your underwriter's commissions, right? All those things, or can be another legal charges. All those things will come under your cost or flotation cost. In the terms of debt or in the terms of taking a loan from a bank, cost is very negligible, very less, right? But that is not the same in the cases with equity. Whenever you choose equity financing, cost is more. That cost is the amount of money, that is the flotation cost that every company has to pay for the purpose of issuing equity shares. Now what is the process of issuing equity shares? The first thing is that you have to list your security in a particular stock exchange, right? You need to list your security, you need to pay brokerage charges, you need to pay underwriter charges. So many charges are there. Those are the examples of cost or flotation cost. That cost is applicable for equity financing, right? I hope this is clear to you. How equity financing is much costlier than the concept of debt financing, right? See now the cost and risk that will differ significantly, or that will vary in the terms of taking a loan from a bank and in the terms of issuing of equity shares. I repeat, the cost involved in taking a loan from a particular bank is much less, but taking a loan from a bank makes it much riskier because a company is under legal obligation to repay back the amount of whatever loan amount they have taken within a particular period of time, right? But that is not the same in the cases with equity financing. In the cases with equity financing, a company is under no legal obligation to repay back to the equity shareholders. So that makes equity financing less riskier, but it makes the equity financing much costlier. Why costlier? Because a company has to pay legal charges, they have to pay underwriter charges, they have to pay brokerage charges. So many flotation costs are there, so many charges are there. That is why that makes the concept of equity financing much costlier but less riskier. I hope it is clear to you. Next, you see, in the cases with your financing decision, the interest paid on debt is a deductible expense for computation of tax liability. Now, whenever a company makes profit, it is necessary to pay tax to the government. Now, in the cases with debt financing, first you need to pay interest on debt. After you have paid interest on debt from your total income, then your total income gets decreased. Then on that total income, a percentage will be paid in the form of tax, right? But that is not the same in the cases with your equity financing. If your company makes profit, then the first thing is that you have to pay tax to the government. After you have paid tax to the government, then only you have to pay dividend to the equity shareholders or the interest to the shareholders. Usually interest to the shareholders are called as dividend to the shareholders, right? Next you see, debt is cheaper but is more riskier for every business because of the payment of interest, and the return of principal is obligatory for the business. Any default in meeting this commitment may force the business to go for liquidation. That is in the second paragraph. Here you see, I have said, I repeat, that debt is cheaper. That means it is less costlier than that of equity financing, because whenever you take debt, there is no charges, flotation charges like your brokerage charges. There is no underwriting charges. If the banker is satisfied with your enough assets or the company's property, then obviously they will sanction the loan. In that case, there is no flotation costs, or even if there is flotation costs like your stamp duty, it is very negligible, right? That is one of the advantage of debt financing. That is, it is less costlier, but it is very riskier. Why it is riskier? Because if your company does not make profit, you need to repay by any means the amount of interest along with the principal value. Okay. Next you see the last line of the second paragraph. Any default in meeting this commitment may force the business to go into liquidation. Here you see, liquidation means what? Whenever you take a loan from a particular bank, the bank is not going to sanction the amount of loan unless and until you pay them security or your collateral property or mortgage. If you are unable to repay back the interest, the bank have got an interest or will have to take away that amount of loan amount by selling the personal properties of a particular company, right? Or by selling the mortgaged amount of value of that particular company. So that is why the debt financing is very, very risky than that of equity, right? I hope this is clear to you. Now see the third paragraph. However, there is no such compulsion for equities, and that is why these sources of finance is considered to be riskless for the business. In the cases with equity, the company is under no legal obligation. That means the law does not permit a particular company to repay back to the equity financer even if the company does not make any profit, right? I hope this is clear to you. So next you see, higher use of debt increases the fixed financial charges, that is the interest payment of a business. As a result, increased use of debt increases the financial risks. Obviously, whenever a particular company uses more and more debt financing, it becomes more and more it becomes more riskier for a particular business, because business is under legal obligation to repay back the amount of principal and also the amount of interest, even if the company does not make any profit, right? That is written in the second line. Here you see, financial risk is a chance that the firm would fail to meet the payment obligation and the interest and principal. So financial risk, here you see, as a result, the increased use of debt increases the financial risk. Now, what is that financial risk? Financial risk, actually, what is the meaning of risk? We have risks, we have discussed in class 11, the meaning of risk. Risk is actually the uncertainty. Uncertainty whether your business will make profit or not profit. Now, in the cases with financial risk, the financial risk, actually it is the uncertainty that the firm will not be able to repay back the principal and the interest value. Okay, I hope this is clear to you. Next you see, that is why the overall risk depends upon the proportion of debt in the total capital. Whenever the debt amount is present in your total capital structure, then your capital structure becomes quite riskier. But if your total capital structure comprises entirely upon equity, then there will be no concept of risk, because you will be paying to the equity shareholders only if your company makes profit. I hope that this video is clear to you. So in the next video, we will be discussing about the various factors that are affecting this financing decision. Okay, thank you very much.